Hi, good afternoon to all. Can anyone hear me? Good evening, pardon me. Hi, good evening to all ladies and gentlemen. So before we start, just do a bit of sound check and technical check first. So those I see a couple of you guys already sign up or sign in. Can anyone give a shout out? Whether can you hear me loud and clear or see my screen? Just give a shout out to me so that I know that everything's okay from the technical side or even the sound check side. Hello. Yeah, can see my screen. Hi there. Can anyone just give a shout out? Can see my screen or anything like that? Hi, can see my screen or hear me? Mic test 1, 2, 3. Hi, or can anyone hear me or see my screen? Can you hear me? Hello. Yeah, before we start, right, I'd like to know, can anyone hear me or see my screen? Can anyone please give a shout out before I start? Yeah. Just type it on the chat box over here. Please, anyone? Okay, so I guess that since no one give me a reply, so I think that everything is loud and clear. So let's just kick started this webinar. Yeah. So as you all know that yeah, so this webinar over here will be the Q2 2022 Global Markets Outlook. So I'll be covering the latest trend buyers, all right? The latest trend buyers as well as what are the key things to look out for in this next 3 months, which is very important right now, as you all know that a couple of months ago, there's lots of things that is being developed on the backdrop of the global markets. We start to see the Fed tightening. We start to see geopolitical tension coming up from Russia, Ukraine. That's unlikely to end soon. And also, most importantly, two major things that's going to happen that has been taking shape in the FX market. All right. So before we start, let's take a look at the disclaimer slides first. All right. Okay. So here we go. So just to keep for those who first time with us, just give a brief introduction about myself. I'm Calvin Wong, part of this APAC market analyst team for for CMC markets. Pardon me. So in fact, I've been in CMC for the past 2 years. For those who actually followed me in my social media account, Twitter, or be it some of your clients, what I do over here is that I do daily commentary on the market on a daily basis, and as well as technical analysis on some forward-looking ideas on setup in the markets across different time frame, from short term, medium term to long term. So the long term will be this quarterly outlook. So for those guys, if you want to follow me to find out what's going on in the market on a daily basis, why dollar yen is so weak, what are the things, the other things to look out for, and potentially what are themes that are emerging in the market that hasn't fully been priced into the asset class. Right, so you can actually follow me at Calvin SC Wong. This is my social media, which I tweet almost every day. Right, so later towards the end of this webinar, I will share with you all how to actually follow me via Twitter. All right, for you guys to get a better understanding on financial markets from a economic perspective. Okay, so right now, yes, so before we start here, let's have a recap of what's our team play or our expectation in Q1 this year. So previously, we have shared my Q1 2022 global market outlook. So this is a recap of not Q2 yet, it's a recap of the last 3 months in Q1. So basically, the first point, the most important point is that stagnation risk has increased significantly, coupled with a tightening of liquidity condition in the US, which is pretty much in progress, as you all seen that we start to see pretty much hawkish view from the Federal Reserve, as well as we start to see progressively increase in this pace of we call it appreciation of the US Treasury yield from the short end to the long end. So indicating to us that we are now indeed in progress of this handling of this liquidity condition in financial markets, which will tend to be spread globally as well. Then also one of the reasons I signal over here is there's this relative strength performance, which is a very important chart that I look at to actually determine what is the current today right now. Actually, in 3-4 months ago, or in fact 6 months ago, we did highlighted that the S&P has started to actually underperform this Bloomberg Commodity Index. So it's an index that is spread across a wide spectrum of different asset classes, commodities, and so forth. from agriculture, from industrial, from energy. So there's this signal that's being detected by the later I'll share the chart. I will share you the chart again, stating that over here is that the circular peak of the S&P may be seen in May 2022. And what you can see over there right now is if you look at the last few weeks of price action on the US stock market, the possibility of this happening has indeed increased. Yeah. So also I did highlight over here is that because of this tightening of this liquidity condition, especially the increase of the 10-year US Treasury yield, there's actually limited diversification benefits for US fixed income, and WTI crude oil and gold may offer better diversification benefits, which is in progress. And over here, then at the start of Q1, we did mention over here is that we are looking for this escape wave or this potential last push up on the S&P 500 and the Nasdaq 100. But however, if you look at the current price action right now, this correction is pretty very low. So the final push up, right, or the final push up of irrationality and hope, I would say is the probably has gone down significantly in the last week or so. So pretty much low correction on this idea right now for this last push up. All right. Then looking at previously, we are saying that at the start of the year, there's this hints or guidance from China top policymakers indicating to us they are more generous in terms of doing their liquidity tap. This, i.e., they are actually in favor of easing monetary policy to actually stabilize the Chinese economy and as well give a bit of floor on this China stock market that has been, or China-related stock market, which is the Hang Seng Tech, the Hang Seng Index that has been underperforming or underperformed the rest of the world in 2021, which is this year. But however, the credit impulse index over here seems to us that already some come down. Later I'll share what's the credit impulse. So despite this ongoing guidance from the China top policymakers to actually ease their monetary policy further, this tactical rebound that we're expecting in Q1 the Hang Seng Index and China Big Tech, which is we can say is represented by the Hang Seng Tech Index, it did not materialize. So this view has been invalidated. And also in Q1, we also expect the dollar to actually strengthen, which everything is in progress. If you look at the last 1 month or so, the dollar has been strengthened significantly, especially against the Japanese yen, which is one of our emerging theme that we want to look out to actually. It has actually significant spillover towards the rest of the asset classes. All right, so this is in progress. And also this Chinese yen, previously we did mention over here is that do be cautious because we reckon that the yuan strength cannot be sustainable. Why by yuan strength? That means the yuan is actually strengthening against the dollar in the last 2 years. So quite surprisingly, the yuan was actually the strongest performer among the major currency. Major developed country currency. But however, we did mention over here that the shrinking discount of the yield spread between the US 10-year Treasury and the China 10-year sovereign bond may put a cap on the yen strength, which indeed happened in the last week. For example, yuan actually weakened significantly as well. Then we have these bullish buyers remain intact on the WTI crude. So WTI crude kind of hit our resistance target at 101, and also gold has started to actually shape and push out a bit at a slower pace. So this is in progress. And previously, we were expecting a final potential up move or a push up for new all-time high for Bitcoin and Ethereum. But however, that condition is low right now. All right. So all right. So okay. So far the voice is okay because I'm using a we call it a headphone. Okay, so far so good. All right, so that I believe that the sound is okay, so I shall proceed there. Okay. Okay, now, so what we are actually looking at right now is that's what Q1. So peak growth, higher commodity prices, plus global supply chain disruption, and together with higher long-dated sovereign bond yields lead to higher cost of funding. So that's stagnation. All right. So right now, right in Q2 over here is this rising long-term US Treasury yield. There's a risk of this 60-40 portfolios getting smashed. No diversification benefits for bonds, fixed income. And next one, this is something just happening right now. or in fact, it's already happened in the last 3 to 4 weeks. That is rapid pace of yuan depreciation, which I actually wrote a report on Q2, two key themes to look out for, which I published on the website, and I did send out a link on my Twitter. So that was about 2 weeks ago to take a look at this yuan or Japanese yen depreciation will actually impact potentially the yuan weakness, which has already been taken shape last week, and all this will lead to the risk of a currency war. And also, because you put all these things together, now there's a potential. So right now we are actually at the potential start of a long-term circular bearish trend. So we're talking about a multi-year bearish trend for this asset and equities. The odds are high at this point in time because of this major regime change that's going to take place. All right. So now, first chart. So this is a very important chart, which is this US, this dollar yen. Okay, what we could see over here in this is a 3-month chart, very long-term chart. It actually shaped a bullish breakout from a 23 close to 22, 32 years. We call it bottoming configuration that is in place in April 1990 high. Such a bullish breakout above 114.50. So right now, what we're actually seeing over here is a potential move up from this start of a long-term circular uptrend, potentially for the dollar yen towards 147.60 slash 149.30, then maximum 159.30 slash 161.50. So all this right is being supported by this ultra dovish monetary policy that's been undertaken by BOJ, which actually is in contrast with the hawkish we call it mode that is being we call it right now to be undertaken by the US Federal Reserve, that actually causes the spread of the US Treasury yield over the JGB yield to actually widen much further. We expect this to widen in the coming months ahead as well. All you know that you see that BOJ right now has pretty much launched, especially in the last 2 months or so. They have been actually putting a ceiling or preventing the 10-year JGB yield from breaching above the upper limit of 0.25%, which is the key resistance 0.27%, technically speaking. All right. So what we could see right now over here is a very start of this potential long-term circular trend for dollar yen. Okay, so now the key thing, okay, we know dollar yen is strengthening significantly. That means we are just expecting this rapid pace of depreciation of the Japanese yen. So how does it impact other cross asset classes? Okay, so this is the next important chart. Now I'll share with you over here is this. Okay, so what we could see right now. Yeah. Okay, before going to just here, let's take a look at this chart first. This chart first. So what we could see right now is this push up in this dollar yen has led the CNH is the offshore yen. So the CNH right now is actually strengthened pretty dramatically against the Japanese yen. So we can see here. So it's 1 CNH equals to how many Japanese yen? So now it's actually approaching a key resistance of 20.20. So what is 20.20? If you look back in time, in early August, in early 2015, the CNH JPY rate hit at 20.20, and after a couple months later, what we see, we start to see a surprise shock yuan devaluation being engineered by the Chinese central bank that actually causes the CNH to actually weaken dramatically against the dollar. So what it means right now is, in terms of the Chinese yuan, is getting relatively more expensive, or in terms of competitiveness, in terms of exports, they're actually losing competitiveness against Japanese exports. So what we could see right now, there's actually a pressure for the for this CNH to actually weaken, which is actually it indeed happened last week or so. It did weaken. So this is CNH. 1 CNH equal to how many dollar? So it's the inverse. So it did weaken dramatically in the last 1.5 weeks. So what we could see right now is everything is being coupled together with, currently we start to see this ongoing stringent COVID-0 policy that has been taken shape in China, where key cities like Shanghai has been extended into extended lockdown, and all this could actually soften economic growth in China. Plus, also over here is that data I'll share with you all, the credit impulse index in China is not picking up despite this easing monetary policy that's been undertaken by China's central bank, means what you see right now is there are more available credit or cheaper credit in China, but businesses and what you call it, businesses and people, citizens, are actually refusing to take up loans to actually boost economic activities. That means, i.e., we are facing a liquidity trap in China. So one of the last resort over here is that to actually maintain or prevent instead of economic slowdown, the Chinese authority, high chance they will actually use this a way which is weaken the Chinese yuan to actually boost exports and as well hopefully to actually stabilize the economic slowdown. So, but however, that could actually has an impact on the global equity market. So what you see over here is that previously the yuan shock devaluation in August 2015, where the CNH hit a level that the Chinese authority is not comfortable with, which is 2020, but now it's coming right below this level. It led to a 15% decline in global equities, as represented by this iShares MSCI All Country World Index ACWI. And right now, the ACWI is also facing the same downside pressure as well. All right. So now, if you look at the technical chart of the CNH less dollar CNH now, that means now you're looking at the conventional way of quoting. $1 equals to how many offshore yen? Okay, you see this dramatic push up last week, which is at 6.4240 level, and all this has been supported by this yield spread, where the you look at the yield premium, where previously the Chinese government bond, 10-year bond has been enjoyed, now has been diluted or evaporated. That means right now the difference between the US 10-year Treasury yield over the China 10-year sovereign bond yield is close to zero. That means the China sovereign bond yield does no longer offer an attractive positive premium for overseas investors. So that's the easiest way to explain that. So in fact, if you look at this this push down in dollar CNH is not sustainable if you look into account of this yield spread between the 10-year US 10-year Treasury yield and the China 10-year bond. So there's a very strong correlation in the movement. If this US 10-year Treasury yield and China bond yield starts to increase up, that means the US Treasury yield has a higher premium over the Chinese 10-year bond yield, it actually supports further dollar strength against the offshore yen, which is actually taking shape right now. So perhaps only we start to see it now it's at the resistance, which is 6.5880. We may see a bit of hesitation of the boost to actually push the CNH, push the dollar CNH much higher. But technically speaking, all in all, we start to see a damage of this major bearish trend 2 years ago, since 2 years ago, which is start of 2020 for the dollar CNH. So what we now start to see is a potential further up towards 6.86. Or that means we are expecting technically for the Chinese yuan to actually weaken for further in coming months ahead, which actually does not bode well for global equities based on the earlier analysis that I shared with you. Okay, so now the next one I'd like to share with you all will be this Treasury yield. So as you all know that the US Treasury yield is the 10-year Treasury yield is used as a proxy for longer term global funding costs. That means, i.e., if a corporation were to actually borrow in the bond market to price their corporate bond, the risk-free rate to price their corporate bond plus whatever credit spread, depending on credit score, credit standing, this will be the first determinant. So if a risk-free rate, so this is called the risk-free rate. If the risk-free rate keep going up over here, overall the global funding costs will go higher. So eventually you'll start to see an impact on the margins for corporation, right? And definitely for consumers, because if we are looking at mortgage loan, floating mortgage loan will get more expensive because part of the reason over here they are also being inferred being priced as from the US 10-year Treasury using the risk-free rate. So it has really broken above the key 2.55% level, which we highlighted in Q1 outlook. So right now, potentially it's 4% will be next, and followed by 5.2%, which is pretty much significant now. And i.e., most importantly, technically, it has really broken a mega long-term downtrend that is in place since October 1987. So that's pretty significant. And what's significant over here is the underperformance of a company that relies a lot on leverage to actually drive bottom line growth, which is those small caps company, and also some of the tech and growth stock as well. So they tend to be more highly leveraged over here. So you can see over here is that the Russell 2000 ratio, I think the S&P has been underperforming, and this underperformance is quickly being seen much more significantly after the recent bullish breakout 2.55% US Treasury yield. And most importantly, right now we start to see a double top that is forming on this high-flying Nasdaq 100 versus S&P 500 ratio. That means what we are saying now is an underperformance of US tech stocks. And this is very significant. Why? Because if you look at the last 10 years, a lot of global portfolios are being heavily skewed toward tech company. Why? Because in order for me to beat the benchmark, I got to allocate a lot of portfolio in stocks, especially US tech stock. But if this significant regime change starts to take place over here, or mind you, there will be a significant we call it allocation or adjustment in this global portfolio that may take shape in Q2 or in fact throughout the rest of this year. And so these are the very important, we call it potential team plays that's actually evolving right now in the marketplace. Okay. Now, next chart. Okay, so this chart over here is I did share this chart in Q1. So what we could see right now over here is the yield spread. So the yield spread between the 10-year and 2-year, 30-year and 5-year, represented by this blue line and red line. It represents an indication of it has a leading element that indicate to us whether the chance of US heading into recession. So once US into recession, that means i.e. globally we are in a global recession, given the significant the US economy that it has for the rest of the world, plus now together with China as well. Okay, so right now if you could see over here is every time the yield curve say for the past, based on the last 1, 2, 3, the last 3 recession, this one caused by the dot-com bubble. So the yield curve actually went down to below 0 for both of them. Significantly was seen during the Great Financial Crisis and 2007, 2008. And this one over here is the 10-year minus 2-year. This pandemic, very short one, session 2000. So right now we are actually seeing that yield curve coming back to actually the 10-year and 2-year has really inverted to go down below 0 about 3 or 4 weeks ago, and then bounce up a bit. So right now it seems to be they're actually coming to actually hit down towards inverted condition again. And so what it means over here is that it's indicating to us that the odds of having a recession in the next 6 months or so is pretty high based on the observation of this curve, 10-year minus 2-year and minus 5-year. And what's interesting over here is the liquidity condition. So this liquidity condition, what I do is I measure it by Chicago Fed National Financial Condition Index. If this index is inching upwards over here, it means that condition is tightening, liquidity condition is tightening. If it's loosening, that means over here is that pointing downwards, the condition is loosening. So what you see over here is that the liquidity condition starts to tighten, and in fact, the pace of tightening is pretty similar or in same magnitude prior to the subprime crisis. Okay, so prior to the subprime crisis in 2007, 2006. So what it means over here is that, hey, this observation doesn't bode well for stock market, right? Because liquid condition is getting affected, right? So yeah, so this is something that we also want to take note of in terms of liquid condition, which is tightening at a similar pace in around spring around early 2007, prior to the crash 2007, 2008, 2009 triggered by the subprime crisis in the US. So now the next thing over here is okay, the question right now over here is that most of us wondering is inflation. Can the current hawkish guidance, because if you look at since late December last year, if you look at listen to major financial media, be it Bloomberg, Business Times, Singapore, or Reuters, we have been seeing lots of hawkish guidance from Federal Reserve officials, well themselves. So the reason why they're actually engaging this hawkish guidance is hopefully based on their guidance, they are able to tame down future inflation expectation. So how we can actually gauge future inflation expectation? We can do it. It's in fact being inferred by this U.S. Treasury market using the inflationary protected securities, and from there we can actually get an implied rate for the U.S. 5-year break-even inflation. This is blue as depicted on my graph, and the U.S. 10-year break-even inflation depicted in orange. So what it means is that 5-year break-even inflation indicates to us what is the inflation like 5 years from now in the future. The white forward, okay. So 10-year will be 10 years from now. So what we could see over here is that yes, in the last couple of weeks it came down slightly a bit, but overall, right, it actually surpassed their previous peak in March 2005, which is very significant. And the trend, the major uptrend still remains intact, still at elevated level. And most importantly, if you look at in the past, this turquoise green line is WTI crude oil price. So if you look at the movement of WTI crude oil price against this forward-looking inflation expectation, as what we call it, inferred by the 5-year break-even and 10-year break-even, they actually move in lockstep. That is, i.e., what I'm trying to actually telling you guys over here is that if, no matter how hawkish guidance the Fed give, if oil prices don't come down, oil prices still remains high at this level, there's very slim chance that inflationary expectation can come down because oil prices are this high. And there's a big risk that the Fed might overshoot over here. Why? Because the Fed themselves may not, whatever tools that the Fed has, which is more demand driven, may not be able to solve this curb or curb this inflationary pressure in the market, or in the economy, because if oil prices is more being determined by the supply side inflation. All right, and plus, right now, given the ongoing Russia Ukraine crisis conflict, based on the current observation that we see right now, it seems to us that this will last for perhaps another 3 months or so. And in fact, both of them are not backing down. Okay, Russia and UK are not backing down, and there's a lot of those conspiracy theory, but all this should actually lead to a supply side problem rather than such demand call it pool inflationary situation. Okay, now next. Oops, okay, the flow regularly, this is the ratio that I shared with you. So this one I really flashed Q1, so I'll share you again. So the reason I share you is because of this signal, it has been formed a negative divergence from here based on the ratio of the S&P and Bloomberg Commodity Index. So why telling us that the S&P actually underperforming commodities. Okay, so this divergence, right, lead to prior circular downtrend in the stock market. S&P declined by 9% during the October 2007 back to 2009, and also the dot-com bubble, August 2000 to September 2002, 41%. So prior to that, there was also a bearish divergence ratio of S&P 500 index, and the significant decline was way back then because it was in December 72 to August 74. Before this 41% decline, there was also this divergence ratio of the S&P 500. So right now, this observation has been spotted. Okay, and most importantly, we're now trying to find the lead time period. So the lead time period over here, previously from the April 1971 to December 1972, so that was 20 months. Okay, 20 months. The lead period from June 1991 to August 2000 was 40 months, and the last lead period was from Jan 2007 to October 2007 was 9 months. Yeah, so if we were to take everything together, on the average, the average is about, give or take. Okay. So the lead period so far, right, is actually 13 months so far. So the median of the lead period right now is 14 months. Give or take 14 months. So what we could see over here is because right now, right, because the market is moving at this April already, so it started in because the divergence was detected in November 2020 to March 2021. So you count from April last year until now, so it's 13 months. So the median of the prior lead periods was actually 14 months. Take into account this median, the median is 14 months. So taking out 14 months minus the current 13 months, we are just 1 month away, plus 1 month. So right now it's April, so it was 1, so May 2022. Okay, so just next month. So that's why there's a big risk. Just based on this company here over here, we will start to see the start of this long-term circular bearish trend. So I'm talking about potential correction, not 10 or 20%, it's about 20% correction on the S&P, which starts off more well for the space. All right. So now, with that in mind, another this a new one that I can share in Q1 is the spread between the relationship between S&P and gold. So let me take some time to explain to you all. So this chart, the green line is S&P, the orange line is S&P versus gold. So if the orange line is going up, that means S&P is outperforming gold. If the orange line is coming down, that means S&P is underperforming. Okay, so this line here, this black line is the RSI. It's a momentum. So those who don't know what is RSI, RSI is a very useful momentum indicator that give us a bit of leading element. So it's leading element whether the price action of a trend does it have strength to actually push up higher, or has the strength, has the current uptrend losing steam or losing trend, losing without momentum. So it's something like it measures the we call it the speed of a car. Okay, whether the speed is slowing down or whether the speed is picking up steam. Okay, so that's how RSI became pretty useful. So this RSI, right, this RSI over here now is flashing. So this is a RSI on the ratio, the S&P 500 / gold ratio. So this RSI is flashing a very clear bearish divergence, whilst the ratio starts to go up, and right now it starts to come down already. I want to break this major trendline support. And most importantly, right, this bearish divergence also takes form similar, but has we got pardon me, has taken shape earlier in August 1999 and September 2000. At this point in time here, where the price action is going up, but the RSI on the ratio, the S&P 500 and gold ratio is coming down over here. So what is indicated to us? It gives us a very clear sign that momentum is losing steam. And after that, guess what happened? The S&P actually declined by 20%. So right now over here, right, there could be a risk. There will be an increased risk that over here is that given the ratio of the S&P and gold is actually losing strength, i.e. what it means over here is that the S&P will actually face this downside pressure similar to what we see during the time. Okay, so something to be aware of. It's a new observation that I share. Right now, next. This one is pretty much important. What I do over here is I try to plot various asset classes together, including Bitcoin, Ethereum. Then I use MSCI ACWI as a benchmark for equities. But bear in mind, because of the significant weightage of the US stock market, 60% of them are being weighted in the US stock market, 40% of the rest of the world. Then what I do over here is that I break down accordingly to fixed income. So fixed income, we have the safest, which is the 20-year plus US Treasury bond, TLT. I use the ETF, which is available in the US stock exchange. Then we have corporate bonds, LQD, which is the higher grade list, companies that has higher credit standing, higher credit score, we call it the investment grade bond. GNK, we call it the higher corporate bond, that is companies that has lower credit scores over here. And if you realize this, that Bitcoin Ethereum. So if you look at this bunch over here, right, very interestingly, right, since November 2021, all of them has been coming down together. That means equity prices come down, Bitcoin, Ethereum, Treasury bond, investment grade bond, high yield bond all came down together. And what's interesting is that the one that is going against this time, even Ethereum and Bitcoin also came down as well last 4 weeks. So it's the commodity side of the story where are represented by agriculture activity. So basically, this also can be tradable in the US stock exchange. We call it the Invesco DB Agriculture Fund, that's been going up steadily. Invesco Commodity Index Fund DBC, similar as well. And definitely you see oil, WTI oil, and gold price recently kind of consolidated. So overall, the trend is still up since November 2021. So overall, what it means over here is that fixed income does not offer any diversification benefit right now. Even though stock prices came down together, but fixed income, there's no flight to safety to fixed income side of the story. Bitcoin, Ethereum kind of a track right now, kind of excitement when it's not showing any potential up as well. But however, the one that's moving up higher is the commodity side of the story, right? So what it means over here is that the one that's offering potential benefit is commodity side. But unfortunately, if you look at the commodities allocation in your portfolio, they only form a very small percentage right now. Okay, so there's some implication I will share that. Okay, now talk about this credit impulse. Okay, so if you look at credit impulse, right? So what it means that credit impulse actually measures new loans divided by the GDP. So it measures to us that whether there be a willingness for what we call it, the economy players and its corporation individuals to take up new loans that are available in Chinese financial system. So you know, okay, one thing important is that this credit impulse index, right, it moves hand in hand with China's CSI 300 stock market. So every time there is actually an increase in credit impulse, the China's CSI 300 stock market actually very in tandem as well. But however, if the credit impulse starts to come down, the market starts to wobble as well. So that's what you see in late 2000, the credit impulse starts to decline. So initially, right at the start of this year, it actually attempted to improve slightly, but look at the last last 1 month or so, it started to actually inch down again. So what it means over here is that there's actually a risk of an equilibrium trap. So despite easing monetary policy for POC, has failed to see an increase in loan take-up. That means over here, corporations and individuals do not want to take up loans, despite right now the loans are offered at a much cheaper rate and much more easily available to them. So this is why I call a potential liquidity trap scenario. That means, i.e., if this scenario starts to persist, going for this persist in the coming months as well, it will not support this recovery in this China CSI 300 index. And if you look at this, also has a very strong correlation to the Hang Seng index as well. On the Hang Seng Tech Index, and most importantly, in the wider, in general, in the wider Asia region, as indicated by this MSCI Asia Index here. All right. So what it means from here is that yes, the China top policymakers are giving us a guidance that we are on the path of a trajectory of easing monetary policy further. But however, the credit impulse index doesn't goes up hand in hand or as what China top policymakers want. That means they are facing this trap scenario where much more cheaply available loans are being taken up as enthusiastically by individuals and corporations in China. So that's what the credit impulse index does not reach up. States actually better turn down. So that doesn't go well. Asia exchange index stock market as a whole is based on correlation and share field, and most of it as well, much more significantly impacted. All right. So now, also if you look at U.S. consumer sentiment, so U.S. close to 3/4 of the economy is driven by consumer and services side of the story rather than what's technology. Maybe in the next few years they become a hub, given that deglobalization, more factories are being forced to go back towards the. But before that, shape, US consumer is still very US. So if you look at the base, we can actually measure it from US confidence. So by using the University of Michigan Consumer Sentiment Index for April, which I think a couple of weeks ago, yeah, for April last week, it kind of improved to 65.7 from 69.4 in March. So you'll know, but look at overall the trend still remains pointing downwards, so it's kind of still that slow. So US consumer confidence still weak. Look at the trend perspective, this chart itself. So that also does not go well. So now let's very quickly look at the S&P sector Q1 2022 performance. So what we could see over here is that in Q1, right, the top performer, right, energy definitely is a performer, 36%. Why? Because of oil prices, higher oil prices. And what's interesting over here is the two key defensive sectors, utilities and consumer, also outperform as well. Okay, but what's underperformed over here is your tech, mega tech company, consumer discretionary, communication service. Okay, so especially some of the big mega tech stocks and consumer services, and most of which is consumer communication services, which is your Facebook, Netflix, consumer discretionary has Amazon as well, right? So yeah, actually being underperformed. So if I were to look at this chart, right, it's a 6 months performance of the ratio that I plotted. So what you can see over here is that energy utilities are the top performer. So this as well as the energy, so it's defensive. The one that is underperforming is your home services, home builder, biotechnology, banks and semiconductor, as well as financials because of the Treasury Yield curve that is sloping downwards, which does not fall for financial stock. All right, so all right, you see this is a rising Treasury Yield. We call it year to date. It is similar as well. Okay. Then I use the factor indices. So what you can see is one performance, the one that is low volatility, value, and high quality actually outperforms. So it's the ratio chart. So it's low volatility versus S&P. So the one that is more skewed towards growth underperforms. It's the momentum, high beta, growth. Okay, all these came hand in hand with rising US Treasury yield curve. So if this US Treasury, this is a US Treasury yield, not yield curve, but the US Treasury yield. So if this US Treasury will continue to maintain this upward momentum, its major uptrend trajectory, which is likely would based on the technical chart I shared with you all, once I break about the key to 10%. That means, i.e., those growth related factors indexes will actually underperform, whereas those indices that are more skewed towards safe, much more conservative or defensive, low volatility, value, and high quality will actually outperform. The brand margin is just relatively mature. That means, i.e., if we start to see the start of a long-term circular bearish trend, in fact, all the sectors will actually come down together. That's very hard for to be able to find. Perhaps one or two stocks may actually outperform in terms of direction. That means the direction is the same, except that they fall as a lesser from here. Okay, so I because I'm now trying to use a different speaker, so okay, so this sound quality is pretty bad, is it? Most of you can't hear. So is it much better now? If I can use it. Okay, how about this? Okay, let me try something. Okay, better? Yes, no? Okay, so let me speak this way. Okay, so my apologies because the room that I tend to use over here, suddenly the room is being kind of renovated. So that's why I'm being used at the open space right now. Okay, to just speak here. So yeah, try my best, okay, to actually speak as loud as possible. All right. So now the next chart that I share with you all will be, okay, so this is a year-to-date performance or the factors itself pretty much similar as well. Okay, so now the next few charts will be the technical chart. Okay, the technical chart of the various major indices. Okay, but before we share the Q2 one, let's have a recap of the performance, a very quick performance across the globe in the last few quarters. Then we have Q1. So if you look at Q1, in fact, all of them are mostly in the red, except for the ASX 200 and the STI. And then below will be the MSCI Australia, the MSCI benchmark, which normalize it according to by the US dollar. Okay, so but all in all, right, you start to see Q1 is pretty much a weak picture compared to the previous quarter. All right, now let's have a recap on the S&P. This is what we expected in Q1 outlook, where we expect this final escape wave towards 4990 before that long-term first leg of that long-term circular bearish trend take shape. So at that point in time, the RSI is still holding above its support level, which is around the 45%, and also above the 50 MA. All right. So what we are seeing right now is that the price action has really dropped below the 55 MA, and most importantly, the RSI has really broken below that support, retest it, and now try to inch down much downwards again. That means what I'm saying that momentum on the weekly RSI is pretty much bearish. So if you put into these elements over here, right, it's very hard for us to actually justify. And also just now I shared with you all that intermarket correlation that does not bode well for global equities to actually indicate to us that the chance of this final push up on the SPX 500 is pretty slim right now, pretty much remote, or the chances has kind of reduced significantly. So what we can see over here is that the peak of that in terms of elliott wave, that big wave 5 already ended in this area over here, which is around 4800 level. So I'll use the 49 I'll use slightly above it, 4990 as my long-term pivotal resistance for this quarter. So as long as this 4990 doesn't surpass, we have a clear break or a weekly close below 4140 over here. So this is pretty much clear support level, which is it tested yesterday. Right, and right now, based on the futures market, we try to bounce off slightly a bit ahead of Apple news, Apple earnings, which is out on Thursday before. Out tomorrow, Thursday after the market close. So if we have a weekly close below 4140, then we start to see the start of this first leg of this long-term circular bearish trend towards the next support at 3720, followed by 3250. So that is the first step first, and definitely it still has a potential chance to retest the March 420 low as well. Now, similar to the Nasdaq 100, so Nasdaq 100 previously we also looking for this push up. So right now, this push-up has been, the chances is very, very slim right now. So I will use 1684 as my long-term pivotal resistance. Weekly close below 12,940 potentially could take us down much lower towards this support area over here. All right, so RSI is pretty bearish. So right now, it just reacted off of this 50% neutrality level. It hasn't inched down towards the open sold yet. All right, so indicate to us that this we call it momentum still remains weak, as indicated by the weekly RSI. All right, so now this is the Dow Jones. So Dow Jones initially was also expecting a push up from here towards this 38450 level. The time there was a bearish divergence really. So this is a recap Q1, but still holding above the support level on the RSI. So what you're seeing now, the RSI already broken below this support level. We tested a couple of 2 weeks ago, and right now it's actually turning down, back down again. So with this bearish observation, that last push up also has been reduced significantly. So using 37060 as my long-term pivotal resistance, we are now looking for a start of this long-term circular bearish trend as well on the Dow Jones Industrial Average. So we're now looking at key support, intermediate key support at the 33K level. So once we have a weekly close below this 33K, potentially it will actually take us down much lower to this support level, which is 29,600 followed by 26K. on Dow Jones. So the one that is the weakest among the peers will be the Russell 2000. So previously Russell 2000, we were kind of neutral between 2367 and 17,040 level. So right now, if you look at the current situation right now with the RSI inching downwards after a retest twice at this previous support turns into a resistance level close to the 40% level, and also the 50-day MA price action has failed to break above this 50-day MA. This 50-day MA is now sloping downwards. I think as an intermediate is at 21,600, 2160. So as long as this key long-term pivotal resistance 23,670 holds, we're not expecting a further push down towards the support level at 17,040 slash 1700 level. All right, so with that down towards 15,040 level. Okay, so overall, right, we are now seeing the start of another long-term bearish trend in the Russell 2000, which is the which is the underperformer among the US benchmark stock indexes. Okay, so now going on next will be the Hong Kong. So Hong Kong 50, right, previously because of the credit impulse at the start of the year, China credit impulse started to pick up slightly. So we tend to have a tactical rebound view on the Hong Kong 50 holding above the key support at 23K. So what's 23K is in fact the long-term circular ascending trend line from the October 2008 great financial crisis low. So initially we're expecting at least a tactical rebound towards 26,700 level, 27,800 level we saw over here. But however, if you look at the price action that was seen, in fact, 4 or 5 weeks ago, it actually broke below the 23K level, which is the ascending trend line for October 2008 swing low. And right now, in fact, it's actually testing the next support level, which is another long-term circular ascending trend. That's from the Asia financial crisis, August 1998 level. So as long as this 24,700 long-term pivotal resistance holds, we may expect a further push down on the Hong Kong 50 to actually retest this 18,050 level, which managed to shape a rebound off from the March low from here. Then thereafter, a bit below it to take us down towards this 16,140 slash 4,650 level, which confluence with this swing low area over here in somewhere around the mid of 2011, as well as this long-term circular ascending trend line from the Asia financial crisis, that's August 1998 low here. So all in all, what we could see right now is there is further downside pressure on the Hong Kong 50 index, as long as the 4,700 long-term pivotal resistance is not being surpassed on the upside. All right. Now, going to Japan 225. So Japan 225, right, previously, or the Nikkei 225, we actually turned neutral in Q1. Why? Because of this impending double top that has been shown since February 2021, where the September 21 high failed to break above 30,716 level, and the neckline of the support is coming in at 26,880, and most importantly, the momentum has shown a pre-leading signal of a breakdown below its corresponding support level. So we in fact turn neutral in Q1, and in fact what we see is obviously a bearish breakdown of this right that actually takes shape in the early first leg of the March period, early March period. So what we could see right now is actually a retest of that this neckline here. Neckline we call it the neckline support broken. There's a neckline resistance level at 28,750. So I'll be using 30,810 as my long-term pivotal resistance to have a bearish view on the Japan 225 for it to retest close to 24,180, and a break below it should take us down towards 21,600 slash 20,240 level. And also noted that the RSI still remains pretty bearish, especially the retest of this former support now turns into a resistance, and it has a bearish reaction in the last 2 weeks. So indicate to us that momentum still remains weak on the weekly, as depicted by the weekly RSI. Okay. Now on the Australia index. So Australia index, right? The Australia has been supported by several commodities related stock like BHP, Rio Tinto, Rio Tinto over here. Because of this, we kind of we have a neutral stance on the ASX 200 in one at 7,660 and 6,800 level. So at this point in time, right, it's still within this range itself. Okay, but one thing not very nice is actually there's a retest of this ascending channel that is being broken downside. Retest it and it actually has a better reaction of this ascending channel support now turns to a pullback resistance, and it seems to me that it's so potential it could be a double top as well. It could be a potential double top. But the RSI seems to be pretty mixed right now. Last few weeks we had to bounce off from this pullback resistance, pullback support line, by being kept by intermediate resistance at the 9% level. So kind of mixed elements on the RSI. So with that, right, I would tend to actually maintain that neutral stance between 7,660 and 6,800 level of the ASX 200. But bear in mind, do keep a lookout on this 6,800 level. So if you have a weekly close below this 6,800 level, which is 6,800, we could actually start to validate this potential double top bearish breakdown, leading to us further potential drop towards 6,200 level and potentially extending towards 5,700 on the ASX 200. Now, what's up next for the German 30 index? So for the German 30 index, right, at that point in time, we also be a bit cautious. Why? Because of this bearish divergence that's been taking shape with the RSI, but the RSI managed to hold this key corresponding support around this 43% level. So at that point in time, right, we are looking for this push up as well on the German 30 index. But what we could see right now is the bearish divergence take shape, and price action has started to break below the corresponding RSI support level, and right now it's also intending to actually shape a further turn down as well. Well, previously, okay, of course, I didn't draw the line here, pardon me, so there's support level being broken, it backed off from this support level, which turns into a pullback resistance. So all in all, what we could see right now, right, is I will use this 16,300 and 16,685 as my long-term pivotal resistance level. So once there's a bearish break below the trigger level, which was actually this March low, which is at 12,430 level, a weekly close below it, potentially could take us down much lower towards 11,330, followed by this 9,580 slash 9,240 support zone, which correspond to the long-term circular ascending channel support that is drawn from the March 2000 level. So all in all, we now have a bearish view on the German 30 index for this Q2. All right. Yes, I'll be sharing the USD index in a while. Okay, now back to our Singapore market, the Straits Times Index, the STI. So if you look at the STI right now, right, in Q1, we're actually looking for that STI to actually outperform to the push up towards 33,090, maximum 3550 slash 3610. Why this level? Because this level is actually the long-term descending trend, the long-term descending resistance of this potential long-term circular symmetrical triangle configuration that has taken shape since the the Asia financial crisis low of August 1998, and previously all the rally has been kept by this descending trend line in place since the all-time high of August 2007. All right, so right now this is the level that we are looking at, maximum push up to this level. So that was in Q1. So for Q2, in fact, right now it's coming very close to this level already. So RSI also come close to a resistance as well. So right now we're just expecting a push down back towards the lower boundary of this long-term circular symmetrical triangle range configuration. So as long as this 36,010 long-term pivotal resistance is not surpassed the upside, a weekly close below 3020 may take us down lower towards 2820, followed by 2630 on the Singapore index, that the Straits Times Index, pardon me, the STI. Okay, so it's at risk of bearish reaction below the major resistance. Okay, so all in all, I already covered the stock market, the global stock indices. So now let's move on to the FX market. So before we start to the individual technical chart of the major pair, let's take a look at the performance of the majors, including the Aussie, the Kiwi, the CNH, and the Singapore dollar, pardon me. So if you look at this, is the latest year-to-date chart as of today, which is 27th of April. So what you could see right now is the dollar has been strengthening pretty much across the board, especially against the Japanese yen, as I shared earlier, due to this divergence policy between BOJ and the Fed that is reinforcing this the dollar strength in JPY. But most importantly is that previously the commodities related indices, the Kiwi, the CAD, and the Aussie dollar, just recently at the start of April, they actually has been outperforming the dollar. But this outperformance has really started to dilute, or in fact evaporated in the last 2 weeks. So previously, right now we start to see the dollar has been performing and start positively against all the currency that I shared right here, right now. So what we could see right now is, in fact, we now start to see across the board strength in US dollar. So now let's look at the US dollar index, which is primarily as a heavy weightage more towards the euro. Okay, over here. So this is a long-term chart. So what we could see right now, this was Q1. So previously we are looking at 103.65 as upside trigger level, heading up towards next to 109.30/112.30. So RSI has been pretty much bullish because RSI has indeed shaped a pre-signal by breaking above this called corresponding descending trend line resistance after bouncing off a key corresponding support at the 37% level. So what's next for Q2? So in fact, Q2 right now, we start to see a very strong monthly candle that has been taking shape right now. It's in fact going to end pretty much soon, because towards the end of April is about only 2 days from now. Next week will be in May. So 103.65 definitely is an upside trigger level. So perhaps we may see a bit of pullback at 103.65, but all in all, right, it's actually a start of a bullish, the long-term bullish circular uptrend still remains intact for the dollar index. So I will actually tighten the long-term pivotal support to maintain our bullish view to 93.20. Looking forward to a further potential push up towards 109.30/112.30 US dollar index from here. So now what's next for the individual pair? So let us start with the GBP, the sterling pound versus dollar first. So this is what we have in Q1. So Q1 we are bearish. We are expecting a push down towards 27.30/24.90. At that point in time, with a break below of 32.70, with the key long-term pivotal resistance at 43.80, the sterling pound against the dollar. So if you look at cable right now, it indeed went down to our support level as intended. We highlighted Q1 27.30/24.90. So this is the latest chart which I refreshed it just a while ago, 27th of April, which is today. Almost hit the 27.30/24.90 support level. So all in all, I could see now it's actually coming down towards the lower boundary of this kind of a this wedgie-like kind of configuration that is in place since Jan 2018 level. So what we are looking next over here is we will tighten the key long-term pivotal resistance to 32.70, looking for a potential push down towards 19.60, followed by 14.10 level on the cable sterling pound versus the USD over here. So still maintaining this bearish bias on the cable itself. So now the next one, a pair of share will be the euro dollar. So this euro dollar, we are looking also a push down below 17.60 towards the lower boundary of this long-term major range configuration that is in place since Jan 2017, which is at 1.0880 level, 1.0815 level. So where we are right now, in fact, it already also hit this support, already hit the support as intended in Q1, and in fact, we broke below this range support level from here. Okay, it's really broken down. So right now we are looking at a downside trigger level, which is 104.60. So this 104.60, right, is equivalent to this dollar index at 103.65. It's equivalent. Why? Because the dollar index has a very significant weightage towards the euro. Okay, so take this level as an equivalent level at 103.65. The euro dollar. So the euro dollar right now over here is that yeah, so this will be a trigger level. So perhaps maybe a bit of consolidation first before coming down. So once we have a weekly close below 1.0460, we could actually reinforce this potential down move towards the next support at 98.40. That means we're looking at a level below parity and followed by a potential extension towards 95.90 on the euro dollar. So in fact, the euro dollar right now, the RSI is still bearish. There is no clear sign of a bullish divergence. So previously there was a bit of bullish divergence over here that lead to this consolidation, the shape. So there's no bullish divergence yet. It's come close. It already hit the oversold level. So a bit of consolidation at the 104.16 level first. Okay, for coming down. So we are watching this first level to actually reinforce a further potential down move of the euro dollar. So now next will be the Japanese yen. So Japanese yen, I highlight to you all is yes, we start to see a very strong push up from here, but the RSI now is coming very close to a resistance zone, a resistance level at around the 84% level. So a bit of overextended in terms of momentum. And bear in mind, there's actually a risk level at 132/135 level based on the inlet wave and the Fibo cluster of Fibo extension projection found at this 132 level, 135 figure level. So we may see a bit of we call it a bit of consolidation or pullback at the 132 level, 135 level, and who knows, a lot of market-based charter that the Ministry of Finance of Japan is getting a bit uncomfortable if the dollar yen were to strengthen to 132/135 level. So we do expect a bit of pullback consolidation at this 132/135 level towards around 12110, 11865. But definitely the key support to maintain this long-term upward trend or circular trend of this dollar yen will be 114.50 longer pivotal support. So as this level holds, we saw the 50-day MA. Potentially thereafter we could see another push up towards 14770, which is similar to the monthly chart I shared with you all. And right now, so confluence with the upper boundary of this major ascending channel that is in place since October 2011. All right. Now, moving on, next will be the Aussie dollar. So previously, Aussie dollar, right? We have we play a bearish push down towards at least 61.8% retracement of this up move from 19th of March towards 25th February 2021. So all in all, right, at that point in time, we have a downside trigger at 70 cents, which is 0.70 level of the Australian dollar, Aussie dollar. So where we are right now, right? What's interesting over here is that it did a test on 76 figure level during the first week of April 2020, but it didn't manage to have a clear bullish breakout of the 76.50 level. And in fact, there was a bearish reaction of it by forming a weekly shooting star at 76 figure level, which is the long-term pivotal resistance that we highlighted earlier in Q1. So that is indeed an important significant level where to prevent any bulls from actually breaking above this level. So we're going to maintain that this 76 figure level based on the price action that we see so far, especially previously right at the first week of April. So this level will still be maintained, and definitely the downside trigger level with 70 cents will be maintained as well. So once we have a weekly close below 70 cents, it could take us down towards 64.60, followed by 60.10 on the Australian dollar. So previously we have a kind of a sideways or neutrality stance between the dollar CAD. Because why? Because the Canadian dollar has a direct co-relationship with the crude. So at the point in time, we have a neutrality stance between 2030, 1.3020, 1.2060 over here. But overall, right, since 2016, this dollar CAD has been shaping an impending major bearish top. Okay, so definitely if we start to see a weekly close below 1.2060, it will actually validate this bearish double top bearish breakdown to take us much lower towards 12020, followed by 10660, which confluence with this long-term circular ascending channel support that is in place since November 2007 low, and as well as a couple of 61.8% Fibo retracement and 76.4% Fibo retracement, making the low of November 2007 March 2020. So overall, right, if you look at the current price action for Q2 2022, price action now is still holding sideways below 130.20. RSI still below corresponding resistance level, which is at 9% level. So all in all, I still no change. It's still trading within this range. So I still maintain that neutrality stance between 130.20 and 120.60 level for on the dollar CAD for now. All right. Unless it has a bearish weekly close below 2060, then I will actually validate this potential down move on this dollar CAD. Right. So now moving on next to the commodity prices over here. So for commodities over here, right, what we are actually seeing over here for the commodity prices is WTI crude. Previously, we are actually expecting this push up towards 103.90, 110 level. So that has really been taken shape. Why? Because it hit a high of 130.50. So right now, right, we're actually expecting another round of potential push up. The monthly RSI hasn't yet to hit an extreme level of 80%. So there's still a bit of room more to go. So we will tighten the key long-term pivotal support to 83.60 level, looking for this push up towards 138/140 level of WTI crude. Then as for gold, so gold previously we are looking at this first resistance at a breakout above 1965 may take us towards 2075/2160, followed by 23 figure level, then 23,350 level. So if you look at the current price action of oil right now, is kind of it may hit very closely the first resistance at 2075, 2160 level. So right now it's just doing a bit of pullback. So we do expect pullback towards this 118.50, maximum 16.50. So I don't want to tighten the key long-term pivotal support to a higher level. So I'm still maintaining this at 16,070/1670/1640 level of gold. So we're still looking to maintain this bullish bias on gold, heading up towards 22,300, followed by 2,350 next move. All right. So now, lastly, will be cryptocurrency. So I'll be covering the majors with the Bitcoin and Ethereum. So previously, we have a long-term pivotal support at Ethereum at 3,100, looking for a push up much higher towards this resistance zone over here. But however, if you look at the last few months of price action, right, it seems to me that Ethereum right now, Ethereum, Bitcoin right now is trading in a ascending triangle configuration. So if you look at the elliott wave configuration, right, it's a A, B, C, D. Then after that, potential be another E wave. So pretty much a sideways range configuration in Q2. So I'll be turning neutral because based on this latest price configuration of an ascending triangle that is yet to is towards the tail end yet, based on the elliott wave perspective. So neutral between 64,900 and 30,100 on Bitcoin. Then how about Ethereum? So Ethereum previously 1930 level, key long-term pivotal support, looking for that push up as well. But if you look at the current price action, it's also been forming this ascending triangle of configuration, which hasn't come towards the tail end yet. Taking account the elliott wave is A, B, C, D. That will be another E wave to retest the lower boundary. So I'll be turning a neutrality. We'll flip to a neutrality stance on Ethereum as well, between these two range of 4,370 and 1,930 level ETH. Okay, so now I have a quick recap of the key points that I cover for this Q2 2002 global market outlook. Is number one, speculation risk coupled with heightened geopolitical tension and a potential currency war may take shape due to a rapid pace of JPY, yen, and Chinese yuan depreciation. And all this is likely to have kickstarted the first leg of this long-term circular multi-year bearish trend for this asset, which is equities. So 60/40 portfolio may be hit badly due to limited diversification benefits for fixed income, based on the chart that I shared earlier. And most importantly, right now, we are on the brink of a potential major regime change where the previous multi-year outperformance, which is tech and growth equities, are expected to underperform, partly due to its heavy loop-sided positioning in the past 10 years, triggered by this rapid pace of global liquidity tightening. And lastly, commodities are expected to outperform. Why? Because currently, the current global portfolios in general only has a small allocation to commodities-related assets. So if we start to see a persistent uptrend in commodities, then we're talking about in oil, in soft, in agriculture, this may force a significant adjustment in portfolio allocation weights more towards commodity that is likely to drive prices of commodities higher potentially. And the last two things is further potential USD strength in general, except against dollar cap for now, based on the technical configuration I shared with you. and also mixed elements on cryptocurrency. So more of a potential range bound movements for Bitcoin and Ethereum for Q2. All right. So right now I've so we have a time. So about 8:20, 8:20 now. So we still have time for Q&A. So firstly, I do apologize for the sound system. I know answer is quite bad. Hopefully we'll do better next time, because unfortunately the room that I tend to use for my webinar is kind of being renovated for whatever reason right now. So I'm using to speak outside, so there'll be an echo. So anyone, just feel free to ask me any question right now. Okay, so what's the risk of stagnation do you see? Yes, based on the chart that I share with you right now, is that the risk of stagnation is very, very high, and I also expect a recession to actually come into next, at least around the second half or next year, the second half of next year. So before the recession come in, the markets will move ahead first. So definitely risk asset, the equity price will actually start to price in this recession risk. And I also do expect over here, the reason over here, right, is likely the Fed got to engineer this sell-off in global equities. Why? Because in order to actually create a new bull market in equities, that means leading to a potential economic recovery again, there must be ammunition for the Fed to cut rates. Okay, because right now the Fed can't do much more to actually based on the current interest rate, low level of interest rate that it has right now. So someone asked me, can I show the second slide again? Okay, so this is the second slide. Okay, then one question is, which asset class is better from investing in stagnation environment? So based on the current situation right now, I share about there's simply potential limited benefits for fixed income as well as equities, definitely. Bitcoin, cryptocurrency, a bit 50-50 right now because of sideways range configuration. So in fact, based on the chart that I share with you, the one that seems to be a better place to actually perform better during this stagflationary environment will be commodities related as well as real assets. All right. So these tend to actually outperform the market, and especially most importantly that these asset classes has been in general portfolio weights has been relatively very low compared to a traditional 60-40 portfolio. So I reckon that there will be a force that because of this, if there's this persistency of this uptrend to continue in commodity prices, there will be a force in portfolio managers to have a much more higher allocation towards commodity prices, which could eventually create a positive feedback loop as well. Okay, 60-40, I'm talking about 60% equities, 40% fixed income. Okay, then within that 60% equity, it can be split further according to the growth of value. All right. Real estate assets possible as well, but real estate asset got to be careful. Real estate asset depending on geographical region. Okay, so we got to be much more careful on real estate assets. All right. So yeah, keep the question going. Which commodity would be better to invest, oil versus agriculture? Okay, so this is a bit of a tricky question now. So if I were to look at the chart, right, based on chart right now, it seems to me that the DPA has a better, higher potential based on chart only than versus oil. So oil, you're going to be careful is that once oil is being controlled by OPEC itself, OPEC is controlled by OPEC. And these oil prices over here, right, at this moment in time, we so got to be mindful that over here, right, this oil price, if OPEC starts to actually being forced to actually increase their supply of oil, it may actually tilt the trend right now. But I still don't think that OPEC will start to increase the supply drastically at this moment in time. So purely based on the technical chart, right? If you just look at the technical chart, right, agriculture as represented by DBA, the ETF, the technical configuration looks much better compared to oil, because oil there's a parabolic move up. So when you see a parabolic move up in oil over here, like what we see at the .com bubble, all this, the potential move further upright might be pretty much in terms of the rate of return might be lesser because oil prices have been hit at a high level if you were to actually invest right now. All right. So where do we go now? Anybody? Yeah. Yes. How about two more last questions before we go? Anyone has? Where do you think Sing dollar is heading? For Sing dollar right now, right? Okay, let me share with you a chart Sing dollar. Okay. Okay, can see my screen, right? My screen is still okay, right? Okay, so very quickly, let me share my screen. Okay, so this is Sing dollar. So bear in mind, right? Sing dollar, right, moves in correlation with the dollar CNH because I reckon that the Sing near where MAS watch has a higher weightage now in Chinese yuan versus the US dollar. So in fact, right now it's kind of testing this resistance level at this 138 level, 138 figure level, trend still up. So if we start to see a break above this 138 level, potentially dollar Sing could take us much higher. Okay, in first step, the 61.8%, then thereafter followed by this range top that is in place since Jan 2017. Okay, so the key support level to maintain this up move will be this support here, which is 133.80 level. Right, so overall, dollar Sing still has a potential bullish bias. If you also take into account technically and as well as the correlation with dollar CNH. All right. So one more last question before we call it a day. Yeah? All right. So I believe that so far so good. My apologies again with the sound system. Hard commodity versus okay. So what is hard commodity? Hard commodities is like your industrial metals, copper, platinum, all this. Or which one is better? Unfortunately, I can't answer that question because I'm not really a commodity specialist. So for hard commodities, right, we got to be more mindful is because some of the hard commodities, right, has a relationship with economic growth. So, but on the other hand, right, certain hard commodities are needed as infrastructure to build clean energy related we call it resources in the next 5 to 10 years. So overall, right, this hard commodities, right, we really got to take a closer look at it. Then for soft commodity right now, with agriculture, right, is more driven by this supply crunch that is coming out from Ukraine itself. Because Ukraine itself is also a major grain exporter. So given the current situation that they are in right now, there will be a global supply crunch from this grain in Ukraine that could have a positive feedback loop in terms of price of it going that's being spread to the rest of this commodity, soft commodity. All right, but unfortunately, that's the best knowledge I could have that I could answer you because I got to dive much deeper to answer that question. Yeah, because I've not done pretty much in-depth study yet. What's which is better? Yeah, semiconductor, is it correlated to commodity? Definitely yes. So if commodity prices are certain commodity prices that is being used as like some, I can't remember what it is, platinum or something, that is being used as a resource to make that semiconductor chip, it will cause commodity prices to go up as well. But unfortunately, right, by right, semiconductor stocks you benefit from it. But because right now there's a fear of growth and there's a fear of this it's a negative feedback loop. The fear of this global liquidity squeeze that has been indiscriminately also caused commodity stock, semiconductor stock to actually show this drastic downturn. In fact, several semiconductor stocks like Nvidia has been underperforming the Nasdaq 100 as well. All right. So, but unfortunately, that's the case because it's built on a negative feedback loop. Once there's this bearish long-term secular trend sets in over here, the global macro headwind will override firm-based specific factors. Yes, too bad. Yeah, even though there's a shortage worldwide. So in fact, right now is macro headwinds override firm-based and industrial-based sectors. Just like what we see in the crash of the great financial crisis, the crash of the dot-com bubble. Very similar to that. So these are all macro headwinds. It will tends to override industrial specific factors that may be supportive. Yeah. All right. Okay, good. So hopefully I can answer most of your question, but don't worry. This particular video will be made available to my Twitter. So those who want to follow me on my Twitter to get a view, to have a recap of this video. So this will be my Twitter from here. For those who follow me, at Kelvin SC Wong. So just open the Twitter. You're able to follow me and most importantly get my daily commentary on what's going on in the markets. All right. So with that, have a pleasant evening ahead, and most importantly for Singapore, there'll be a long weekend. Tuesday and Thursday will be a public holiday, and it's a much needed break for me as well. So enjoy your long weekend, and I see you all again soon, hopefully in person. If I could hold a seminar in CMC office. So with that, take care and stay healthy. Okay, guys, I'm finished. 会去楼下没有啊？楼下没有啊 ？I thought you all at the June 95 go there. But you all work until what time? Then can 啊，我哪天有做这个？I will.